I welcome you to this class, and this class we shall be looking at the introduction to financial accounting. You know, most students believe that financial accounting is a difficult course, but it's just all about principles. When principles are being laid down and be followed, then it will be easier to report any financial transactions of any company. By financial accounting, the aim of financial accounting is providing a reliable statement, financial statement, that various stakeholders can really assess the company in question or the reporting entity in question. So financial accounting aim at finding the result of an accounting year in terms of what? The profit or loss, assets and liabilities. In other words, to do this, it is essential to record the various transactions in a systematic manner. So, financial accounting is an art and also a science. Of first thing is classifying. So those business transactions, we want to we'll classify them. And secondly, we'll also analyze those transactions. Thirdly, recording business transactions in a systematic manner in order to prepare a summary at the end of the year to find out the result of the consigned accounting year. So, accounting is just a process of recording, classifying, selecting, measuring, interpreting, and communicating the financial data of an organization to enable users to make decisions. That is what we call accounting. So, an accountant must not only be interested in recording or in record keeping alone, but in the application of his professional competency or knowledge and skill in presenting accounting information to assist management decision making. So all we do in accounting or financial accounting is to record the transactions, and these transactions are financial data of organization, and presenting them in a suitable manner, and as well as communicating them so that the relevant users or stakeholders can make proper decision. So, but before accounting, there exists a bookkeeping system. So it is necessary we look at what we mean by bookkeeping. What is bookkeeping? Bookkeeping is the systematic recording of transactions on a daily basis in the appropriate books. It is an integral part of accounting. Since accounting is concerned with the uses to which the bookkeeping records are put, the analysis and interpretation. But bookkeeping is just making sure that records are being made whenever there is a transaction, a financial transaction, and this record must be must be kept, or these transactions must be recorded or kept in the appropriate books of accounts. So everybody can become a bookkeeper as long as you are keeping record of financial transactions. But accounting is the advanced level of bookkeeping in the sense that accounting bookkeeping is an integral part of accounting. So in accounting, we record, we classify, select, measure, interpret, and communicate the financial data of an organization. That is what we do with accounting. So, let's look at what we mean by transactions. What are business transactions? What constitutes a business transaction? A transaction means an activity. A business transaction means any activity which creates some kind of what? Some kind of a legal relationship. For example, a purchase of material, purchase of machine, purchase of equipment, sales of what? Of the company's product or goods, appointing an employee, that is, employing an employee and paying his salary, payment of various what? Relevant expenses, rent, transportation, purchase of assets. These are what we call business what? Transactions. As long as there is a legal what? Obligation. And not that there is a legal obligation alone, there is an outflow or expected inflow of revenue, of income, of money. The resources, as long as the legal obligation is creating an outflow of resources of the reporting entity, or an inflow of resources of the reporting entity, such transactions are what we know as what? As business transactions. So these business transactions must be classified. They must be classified. They must be recorded. And apart from being recorded, they must be summarized. And the summary of it is all about what? Presentation of financial statements. So let's see. We must classify the business transaction. So classification of business transaction. Before recording any transaction, it is essential that it is to be classified or categorized. And a transaction, a business transaction, can be classified as cash transaction and credit transaction. What is a cash transaction? What is a credit transaction? A cash transaction is any transaction, any contractual obligation, any legal obligation of the business in which the resources of the business will flow out, or resources will come into the business. That's immediate what? Payment, or immediate what? Receipt of cash is being done. That is what we call a cash transaction. That is, there is an immediate inflow or outflow of what? Of resources. Such a transaction is referred to as what? Cash transaction. That is, if it is an outflow, for instance, where is an what? Where is an outflow? Outflow here means what? Payment. That is, for instance, e.g., rent. Cash is being paid immediately. Or check is being what? Is being issued. So your cash transaction is the paramount information there is that what? Payments are being made immediately, either in form of cash or in form of check. Or there is an inflow, receipt is being earned in form of what? In form of cash or in form of check. Such transaction is referred to as what? As cash transaction. A credit transaction is one in which payment of resources or receipt of resources is being deferred, that it is being postponed to the future date. That is what we call a credit what? A credit transaction. So similarly, transactions of receiving income and payment of expenditure can also be segregated. So even in case of expenditure, for instance, if it is expenditure, if it's transaction involve what? Expenditure, we can what? We can segregate it into two, although we'll be coming to that. We have what we call the capital expenditure. Capital expenditure. Capital expenditure. And we have what we call revenue. Revenue expenditure. A capital expenditure is one in which what? In which a large sum of money is involved. And this large sum of money is engaged in acquisition of an asset. Acquisition of an asset that will be used in the course of the ordinary business. That is, the asset will be used in the production of what? Of the goods and services. While a revenue expenditure is a year in, year out expenditure, it does not involve the acquisition of a tangible asset, and as such, it is what? It is tagged as revenue expenditure. This revenue expenditure can be called recurrent expenditure. There are salaries and wages. There are year in, year out expenditure, electricity bills, sundry expenses, stationery, and so on and so forth. Where it is a receipt, where it is a what? A receipt or a revenue. Where it is a receipt or a revenue that is coming in. Where is a receipt or revenue that is coming in, it is also tagged as what? Capital revenue and recurrent revenue. So the business transaction is being classified into two major parts: a credit transaction and a cash transaction. The next is recording of transactions. Recording of transactions. The essence of financial accounting is recording of transactions, keeping adequate and proper records of transactions. In accounting language, recording of the transaction is known as entry. So when we are recording transaction, we mean that what we are making entry for the transactions. There are all well-defined rules for recording various transactions in the books of what? Accounts. As per the rules of financial accounting, each and every transaction is recorded as two places, and hence we call that as what? Double entry system of what? Of accounting, which we'll be looking at in the subsequent what? In the subsequent classes. So we move to the next, a summary of transaction, so that we can present what we call a financial statement. A financial statement comprises of what? It comprises of the statement of our profit or loss account, or what we call the comprehensive statement of profit and loss account, and other incomes. It comprises of the statement of financial position. We'll be coming to financial statement. What is financial statement? So the summary of transactions. After recording all transactions, it is essential to prepare a summary of them, so as to draw a meaningful conclusions. So the summary will help in finding out the profit or loss of a particular year, and also ascertain the assets and liabilities on the particular what? On the particular date. In fact, the very purpose of financial accounting is to know the result of a particular year. So from this angle, the process of preparing the summary is extremely what? Important. So because we must prepare a summary of records, that is why we must know what it takes to prepare a financial statement. Because every entity, I said it again, every entity requires a financial statement. Now let's go look at the importance or significance of accounting and bookkeeping, financial accounting. Okay, the importance of accounting information is to facilitate planning and decision making. Although the accounting processes use previous economic activities of an entity, despite the fact we still have some importance of financial accounting. Let's look at them together as it appears on the screen. The first is that accounting information can be used for decision making. It's used for decision making. Like for the analysts, although we will still be coming to users of accounting information, like to the analysts, they can use it for determining a viable and a profitable enterprise in which they can advise their clients to throw in their resources in there by purchasing the shares of such a company. Secondly, it provides permanent record for all transactions. And as we have explained what transactions are, transactions could be in form of cash or credit, and any of them can be classified as capital or revenue expenditure or capital or revenue receipt. It is useful in calculating the risk involved. It is useful in calculating the risk involved. So financial information of financial accounting is necessary. So one of the significance of accounting information, financial accounting information, is it is significant for calculating risk involvement in financial decision. So that is another importance. Another importance that it is useful in evaluating the potential of the entity to earn profit. That is for profit forecasting. Accounting records are useful for tax assessment. The tax authority also makes use of it to assess the reporting entity, that is the company, to assess the company tax, total tax of the company or tax liability of the company in question. It helps to prevent fraudulent practices since there are financial records. There are financial records, their records have been kept properly. Another benefit is that the record shows the income and expenditure of a company or reporting entity in question. Also, the assets and the liabilities are also shown by the accounting records. Then it is useful in deciding how the resources of an entity are being allocated. So these are the usefulness of financial accounting. One, we say this accounting information can be used for decision making. Secondly, it provides permanent records for all transactions. Thirdly, it is useful for calculating the risk involvement or involved. Fourth, it is useful in evaluating the potential of the entities to earn profit. And five, accounting records are used for tax assessment. And six, it helps to prevent fraudulent practices. And number 7 here is that the record shows the income and expenditure. Number 8, the assets and liabilities are shown by the accounting records. Then 9, it is useful in deciding how the resources of an entity are to be allocated. Okay, let's go look at I haven't considered the importance of financial accounting information. It is necessary we look at the limiting factor, the limitation to accounting information. There are some certain limitations to accounting information. So let's go look at that. Despite the usefulness of accounting information, there are some limitation of this accounting information. Number one limitation we have there is that what an accounting system can only record items that can be given a monetary value. Remember, it is transactions are only recorded in monetary value, so there is no information as to usefulness, size, or quantity, because accounting is expressed in the monetary terms. Okay. Secondly, the accounting process uses previous economic activities of the business to form the basis of accounting records. They deal with historical. It is historical in nature. So accounting information is historical in nature. Recording is after the event must have taken place. So historical information is what they based on. The accounting process cannot reflect the mood of the business. It can't. So many items on the financial statement are the result of estimate. For instance, the accumulated depreciation and the provision for doubtful debts. They are estimate. The preparation of financial statement at a particular date may not reflect the trend of the year. It is certain it may not reflect the trend of the year. Maybe at the end of the year, the financial bill, it was the later month of the financial accounting period of the company. What happened? The business boom. So but the whole year is what is being put into consideration. The accounting period of 12-month calendar is what's being put into consideration when preparing a financial statement. So the preparation of the financial statement at a particular date may not really reflect the trend of the year. Okay. Also, accounting policies differ between firms, and this makes comparison difficult. Comparison is very, very difficult when it comes to the financials of one company to another company, or financial of one company in one industry to another company in another industry. So the accounting policies differ, and the accounting methods being adopted sometimes also differ. So these are the basic limitation of information provided by financial accounting.